Now let's finally close off with the birthday boy, Mr. Aaron Dunn. He's going to provide a
All right.
synopsis of small cap gold stock, his playbook, 7 timeless rules for picking winners in this segment.
This segment is based on an article that I wrote. I think we sent it out about a week ago, just on what types of evaluation metrics and things you should look at when you're evaluating a gold investment like a gold stock. And of course, this is very, very topical because gold itself has been a huge performer in the market in 2025, given everything that's been going on. So the title of the article was the Small Cap Gold Stock Playbook, 7 Timeless Rules for Picking Winners. And that's what we're going to go through today. So just taking a look at recent performance of gold, the price of gold right now, over 3,300 per ounce. So it's up about 26% year to date, 43% over the past 12 months. And gold miners have actually performed a little bit better than the price of gold. So if I look, for example, at the VanEck Gold Mining ETF, it's up 51% over the last 12 months. Now, this is not typical. I mean, we don't check in on this all the time to see how the commodity gold and gold miners perform relative to each other. But we have compared the commodity price to some of the large diversified producers of gold like Barrick, and determined that really miners are not the greatest proxy to the price of gold because they underperform. But that is always obviously going to be on a case-by-case basis. And particularly when you're dealing with small cap companies, you have the potential for some very explosive growth and also opportunities to purchase assets at more attractive valuations sometimes. So why is gold performing so well? Well, gold is kind of seen as like a hedge against global instability, weakness in the US dollar. There are obviously the trade tensions, geopolitical instability that we've been seeing, inflation concerns. All these are coalescing essentially to make gold look attractive to many investors as an alternative to, conventional financial assets and currencies. So not all that glitters is gold. And, why does a systematic approach matter? When you're investing in a company, you can have all of the bullish sentiment in the world, but ultimately the company is going to succeed or fail based on what that company does, the fundamentals of the business, as we would call them. So this is the balance sheet, the specifics of their minds, all of this. So it's important to be able to understand at least some of the main points if you're going to invest in individual stocks, just so you can even ask the right questions. Now, small cap miners carry even higher risks because they're generally less diversified than larger miners, in some cases only having one mine, and in many cases in areas where the geopolitical risk is high. So many companies can outperform based on their own fundamentals, whereas some companies can actually underperform and completely fail, even in a period of favorable gold prices, because they don't have a strong business, essentially, to take advantage of that opportunity. So that's why a systematic approach is impossible. How do you separate the quality companies from the higher risk companies or more speculative businesses? And that's what the 7-rule framework is about. Now, I'm going to give the full disclaimer. I am by no means an expert in the mining industry, but this is what I've come up with based on the research that we've done. Okay, so rule 1, follow the cost curve. What does this mean? It essentially looks at a company from the perspective of what are the costs to produce the gold. So the all-in sustaining cost is or AISC is generally the metrics that is used to measure what the expenses are, the total costs, including sustaining expenditures, per ounce of gold, essentially mined and sold. So if you look at the industry average right now, it's hovering around 1,500 per ounce. That is rising, and we would expect it to rise as, just from general inflation, but also as the gold price goes up, more capital comes into the industry, exploration, production expansion, and that pushes prices up in the industry. So it generates additional inflation in the industry. So why does this matter? Well, low-cost producers are in an incredibly strong situation relative to high-cost producers. One, they make more money even when the gold price is strong, but they're also far better positioned to survive gold markets. So looking at the costs, comparing them side by side is important just to understand where a particular company compares with its peers. But also, what's important is understanding how the costs are increasing. So, as I said, we would expect some inflation. We would expect the cost to increase over time. But by how much? So some companies will be better at managing those higher costs than others, and it's important to know if you're looking at a company where the costs are accelerating at a far greater rate than the industry norm, that's something to inquire about. And if it's a company where the costs are increasing but at a lower rate than peers, then that's something that's positive. But you will still want to inquire as to why they're able to do that. Rule number 2, grade and geometry beat hype. So what does this mean? This means, really ultimately, when a company is mining a deposits come in all shapes and sizes, quality levels, and it's important to know what it is what is you're mining. I mean, going way back, we remember there was a company that we had coverage on, and again, I'm not an expert when it comes to the geology of resource deposits or mining at all, really. But we have seen examples where companies have been able to mine out of a certain mine where it happened to be high grade and a good geometry in terms of being able to extract the minerals profitably. And then they'll purchase another mine, and you would think that a lot of people would think, well, they have that track record, but often the new mine has a completely different geology or resource deposit. So it's important to know, because in many cases it can completely change the expectation in terms of how they're able to extract that gold or the other resource profitably. So there's different metrics that you can look at. Really, this is something that if you're going to be a resource investor, you kind of just have to have a general sense of what the different types of deposits are, what is good, what is bad. And a lot of that's going to come from talking to management. You can just ask management about their deposits and how they compare, and what some of the specific risks or benefits of their particular type of deposit provide. Rule number 3, geography and risk connection. So this really comes down to where are those mining assets located. Political stability is incredibly important, because you can have the greatest mine in the world, but if a civil war breaks out right beside it, or there's no law and order, and you're constantly having to deal with bandits, or if you have to fear a government expropriation, things can change very quickly. So knowing which countries are mining friendly, which countries are not mining friendly, where the assets are located in the company that you are investing in, these are very important. Now, several Canadian provinces rank very highly, and Brendan will be happy to know that Saskatchewan is one of those. Whereas there are many African nations that are in the bottom 10 in terms of just political risk. Now, one of the things that I notice when I look at a list of small cap gold producers is that there are quite a few that have incredibly attractive profiles from a profitability and valuation perspective, but they're located in some of the most precarious regions in the world from a risk perspective, geographic risk perspective. So that has to be considered as well. Now, again, we have recommended companies that do operate in regions which are higher risk, but we just made sure that risk was understood, and also that was factored into the price that we were paying. We were paying such a good price that we were okay with accepting that level of risk, essentially. Number 4, balance sheet foundation. So this is really any company. It's not just gold. It's not just small cap. It's any company. The balance sheet is really the foundation of the business. This is the debt and the assets. The most liquid of those assets being cash. So you want to make sure that a company is not too overly leveraged with debt. If it is, you're building a business on a very shaky foundation, and any type of problem, that business can collapse. So when you're dealing with companies with debt, there's certain metrics you look at, like net debt to EBITDA, current ratio. But what we notice is that a lot of the companies in the small cap space have what we call net cash, or they're cash rich companies. So lots of cash and little to no debt. Ideally, these are the types of companies we like to invest in. So it's a high percentage actually of the small cap universe are net cash. But also a fairly high percentage have negative working capital, which essentially means that they don't have enough cash and short-term assets on hand to necessarily pay their short-term liabilities over the next year. They may fund the difference with internal cash flow. They may have to resort to debt financing, but generally you want to have positive working capital. So looking at the balance sheet. Rule number 5, management alignment matters. So important, particularly with small caps. I mean, you could have the greatest assets on the planet in the greatest industry with the greatest opportunities. But if you have a poor management team, they can definitely destroy that opportunity. So there are many ways of evaluating a management team. And believe me, that's a segment unto itself that would barely scratch the surface. But one of the things we do like, particularly in small caps, is we like companies where management and board own a meaningful percentage of the shares, therefore being aligned more with shareholders. Ideally, they own those shares due to purchases in the market and not just from stock options. But if a company owns about 5% or even 2 to 3% of a company, especially if they were buying in the market, that's a good sign. That's a good sign that they have optimism in the business. They're aligned with shareholders, and it also, I think, affects their decisions, because we see management teams that aren't aligned with shareholders often make very poor decisions, or poor from the perspective of providing value to the shareholders, not necessarily poor from the perspective of providing value to themselves. So, as much as possible, we want to align management with shareholders. One of the ways is what is called skin in the game, or by them, management owning a significant portion of the company. Rule number 6, seek growth catalysts. So what does this mean, a growth catalyst? Well, this is just some event which you see happening, or a high probability of happening at some point in the future, that will result in a increase in, well, the share price, but likely an increase in production, or an increase in cash flow that will drive an increase in the share price. So in the context of small cap mining stocks, what would that be? Well, that could be a new mine coming online. There are companies out there that are planning new mines. That could be companies that do acquisitions. Maybe they have announced one. Maybe they're looking for acquisitions and they have a lot of net cash. So you think that there's a high probability that they will. Could be, in this case, exploration results, which could lead to longer mine life or greater production at an existing mine. But some type of story that is, or, well, not a story, but some type of a growth strategy that is understandable, whereby you're seeing production, revenue, and cash flow grow over time. Now, of course, the commodity price can get in the way, but this is what the company can control, are these growth catalysts. How do you find them? Talk to management, look in the presentations, look in the different documents and the news releases. If they have good growth catalysts in place, I'm sure they're talking about them a lot. And then finally, valuation discipline. So this is really, in many ways, where investing goes from being more of a science to an art. Valuation is really, what are you paying for that stock? Not the share price, but what are you paying relative to the underlying earnings or assets? So the simplest valuation metrics one could look at would be a price to earnings ratio, price to cash flow, or price to free cash flow. You could even do an enterprise value, or price to ounces in the ground resources, or a price to net asset value. But essentially we generally prefer cash flow and earnings valuation metrics for our type of analysis. And really, valuation is not about buying the cheapest stocks. That's not what value investing is. Oftentimes, the companies with the lowest valuations are more speculative, and that's why they are selling for cheaper. In the example here, there are a lot of companies that we found in the gold space where the fundamentals are strong, the valuations are low or relatively low, but they're in very dangerous jurisdictions politically, and that's the reason why. So it's if you see a company where it looks like an opportunity from a valuation perspective, you always have to ask why. But essentially, really, valuation is just about not paying any infinite price. So trying to find companies that, they're not too expensive. They might not be the cheapest, but they're good, solid businesses with growth drivers in place. And that's how you handle the valuation. So you put this framework together, and essentially that is what you use to evaluate companies before making that investment decision. And this could even be done in a checklist. You can create your own checklist with these rules. You can add different rules. And every time you go through a company, you can just basically fill out each one of these things: cost, resource quality, geographic risk, financial strength, management quality, growth drivers, or valuation. And if you don't have the answers, well, then that's something you need to go. You need to go out and get. But this is this is one way that we believe that you can approach investing in small cap gold companies in a way that will potentially maximize that opportunity, potentially, while also managing your risk.
Yeah, good job. Like and even like this last Friday, Ryan ended up bringing, like, in our analyst meeting, Ryan ended up bringing, a cash-rich producer. It is maybe a little bit more geopolitical risky. We were looking into their estimated, mine life. Might not be that long, but like this is exactly, what we're talking about is, Aaron saying like, what's a good price to pay? Going through these steps and checking it off and figuring out what's a good price to pay. Like this company, it's all in sustaining cost is about like $900 per ounce, where, like Aaron was saying, industry average, or, is about 1,500, something like that. Like this company that we're looking at, again, cash rich. I think they had about 20 million on the balance sheet in cash. In 2024, they recovered about 78,000 ounces of gold. Looking forward to fiscal year 2025, they're looking at, about 15% growth in their gold recovered. So, these are the things is, we're looking at it, and really kind of, trying to figure out, is, the risk worth the reward, or is the reward worth the risk? What's a good price to pay? Is it trading at a reasonable valuation?
Yeah, and we can run it through those 7 criteria, and
Mm-hmm.
that's what we're doing on a weekly, daily basis, just looking as many companies as we can, comparing them, and trying to find the good businesses. Right now, and if you do look at a lot of the junior mid-tier gold producers, you have to be cognizant of the fact that this is the best environment they've seen in terms of gold pricing basically ever, and the spread they're making is quite high right now. Perhaps gold stays at these prices and even moves higher, but typically gold has had fluctuations in terms of where it is in price. So I wouldn't just be using like the cash flow in the last 2 quarters and annualizing that going forward, into a discounted cash flow model and saying this company is worth this. You've got to factor in the volatility in the price of gold. So
Yeah.
there's some gold companies that look extremely cheap right now. If the price of gold suddenly comes down, they're all in sustaining costs are 1,500. It goes down to 2,000. I'm not saying that's going to happen. It can happen, but now you're making 500 where you might have been making 1,200. So it's a significant difference in terms of the spread there. So that has to be factored in for sure.